This is the Doc with SilverDoctors.com. Today we're pleased to welcome precious metals analyst and chart technician Turd Ferguson of TFMetalsReport. It's great to have you here today, Turd.
Doc, thank you very much, and pleasure's mine.
All right, why don't we start right off with the metals here. Silver had a nice pop on Friday. It got back above 28, and gold also rallied strongly back above 1600. As you know, sentiment for both metals has been probably the lowest for the entire bull market recently. I know previously you've made some statements that you expect strong moves in both metals later in the second half of 2012. What's your current take on the metals?
Well, there is a lot of despair, and it's been painful. It's been, what silver peak, 14 months ago? I mean, if I had told you during that first decline with all the margin hikes and everything back in May of 2011 that, well, hey, this is nothing, man. We're going to deal with this for the next year. A lot of people would have just thrown up their hands. It's always at the end when you get that kind of capitulation. We haven't really seen a dramatic price capitulation as much as we've seen kind of an emotional capitulation for folks. And that's part of setting the stage. I mean, we've gotten so many people ground out of the silver market, especially on the COMEX post-MF Global. There seems like there's nobody left trading. That's the kind of platform from which you can move forward. As much as it's been painful, and it seems like it's continued to go down through May and June, it really hasn't. We've been in a range-bound trade, loosely bounded by 27 and 29 in silver, and about $100 range in gold from 1530 to 1630. Kind of, with the benefit of hindsight, we'll be able to look back and say, well, look at that big long base from which this move started. But as we've been going through it, it feels like we're still just agonizing decline. When in fact we're really in this $2 and $100 range, and we still are this morning.
Right, and I think it'll be interesting, as you mentioned about we still haven't seen a capitulation. It'll be interesting whether we actually see one in this correction. It seems like everybody's kind of waiting on the sidelines, waiting for that last huge smash that often characterizes the bottoms, but long-term secular corrections don't always have a capitulation bottom.
Yeah, and that's true too. And you could make a case for in silver the 3 or 4 waterfalls down, that the last one, really bad one, being in April, end of February and into March, that maybe those were the moments that drove people out. I don't know. It's anybody can look at the chart in silver particularly, but gold too, and say, gosh, there's got to be a whole bunch of sell stops. For long held positions. There's got to be a bunch of sell stops below 26 and a lot below 1525. And the way the computers are driven by HFT and by the cartels, it's got to be tempting. I mean, their mouths have to be watering at the prospect of beginning some cascade event and driving it through there, letting it generate its own momentum, and then sell back into all of the selling that gets generated as those sell stops get tripped. The challenge will be, and as you know, I've developed some pretty good list of contacts in London. The challenge will be, how do you drive paper price down when physical demand is as strong? And I've been discussing that with Andy McGuire for a couple of weeks. He's of the thought that the physical demand, and who am I? I'm just this guy. He's actually in touch with all this stuff in London. So, his opinion is about 1,000,000 times more valid than mine. But he feels that the physical demand, every time price dips, and why the paper price keeps finding these floors, is because of this physical demand, this really strong physical demand that appears at those price levels. That physical demand will keep paper price from falling. I look at it and I see, well, what I just said, that how can, anybody, Stevie Wonder can see the amount of stops that have to be present below 26. And so we'll see. Physical demand may keep it from falling any further and then eventually return higher, or there could be a spike down. They're both possible, and we just kind of got to be mentally prepared for both, I think.
Right. Now we have to throw in, too, that the U.S. is pretty much officially rolling over. We're doing this interview on Monday. The ISM just printed at 49.7 today on expectations of 52.5. Just a terrible number. I think it's the first print below 50 since July of 2009. And we have a jobs report coming out this week. So with the U.S. heading back into recession, how do you see this affecting the metals?
Yeah, that's going to be, the hard part about the employment report is it's such a joke anyway. I mean, it's just the best guess that they can do. Mostly it's all guesswork on the account of the Bureau of Labor Statistics. Then you throw in the fact that it's an election year and the political ramifications of a rising employment rate, unemployment rate, all that kind of stuff. But that said, looking at the picture as a whole, as lousy as the May number was that was reported back on the 1st of June, and you look at the data that has come in over the month of June, and then you throw in the uncertainty of this whole Supreme Court Obamacare issue. I mean, if you were an employer and you don't know, I mean, if this is part of your plans, there's got to be some out there that we're looking at this going, well, I don't know if I'm going to hire this month. I'm going to wait and see what the future status of our health care plan might be. Or at least, if anything, I can certainly hear the panel on CNBC using that as an excuse for a lousy jobs number. I would imagine you can too. Anyway, everything points towards a pretty lousy number on Friday. So it would not surprise me in the least if we get another pretty strong metals move come Friday. And maybe that'll be the thing that finally busts us out of these ranges.
Yeah, Supreme Court, it's been hot. They'll blame it on something.
Yeah, exactly. I mean, that's what they'll say. They'll say, well, the weather was lousy and a lot of uncertainty over the healthcare thing, and so nobody was hiring, and then we had the elections in Greece, and so blah. They'll have, and a lot of that, though, frankly, is kind of legitimate, too. And so as we look forward 4 days, I don't see any reason. I mean, I have a hard time seeing Hampton Pearson at 8:30 on Friday saying, up 250,000. I just don't think that's going to be the headline number. It's going to be up 27,000 or 17, and a number like that ought to spike the metals pretty good. So keep your fingers crossed.
Yeah, it'll be interesting. Well, let's get back a little bit to what you were talking about with Andrew McGuire as far as the physical demand. And I know Jim Willey's been stating that too recently, that there's been an Asian group of investors that have been taking massive physical delivery of gold purchases. Mm-hmm. I know we've seen that 90% silver supplies, wholesale supplies, are like vanishing right now. So what are your thoughts as far as the gold, and with all those, also the 90% that it seems to be some wealthy individuals are pretty much taking all available supplies off the markets?
Yes, it does. The challenge for me is to look at individual events, or like mint demand and stuff like that. That is all anecdotal evidence, and then it's challenging not to apply that kind of writ large, and say, so therefore, supply is really tough. And there are lots of people that come on my site and yours too to tell us how, no, there's plenty of supply. But again, you got to kind of go with your gut and your trusted sources. Andrew talks about that a lot, about the demand that he sees in London at and below certain price levels, but even above certain price levels, that the demand just shows up every single day, and that the metal is leaving the LBMA vaults and moving points east. Which, again, how can that surprise anybody? I mean, if you were, let's say, the Chinese or the Russians or anybody sitting on dollar reserves, why would you not be diversifying? I mean, they have been for years, and why would you suddenly expect them to not be diversifying, especially at lower prices versus last year? So this money this metal is, the dollars are being converted into hard assets, gold and silver being part of that, and then that gold and silver is leaving the system, and actually it would seem, again, it's anecdotal evidence, but I'm hearing stories about great efforts being made by LBMA banks to not deliver outside of the system. That, you can place an order with us if you just simply allow us to transfer some paper certificates around or to drive a forklift from one side of the vault to the other. But if you want a couple million ounces and you want us to ship it somewhere, well, I'm sorry, you might have to go someplace else, because they're trying so hard to keep that metal within the system, because again, the system is all based on this kind of fractional reserve bullion banking. So every ounce that leaves the vault conceivably reduces their ability to leverage 100 to 1, if some folks are to be believed. So I think there is a great effort to keep metal in the system, but the demand is there, and it's that demand when people say, how can they, how will we ever stop the paper manipulators from suppressing price? Well, it'll be that physical demand that will ultimately break their back. I mean, that was the kind of the goal behind the buy silver crash JP Morgan idea, and that's still the goal today. I mean, physical demand will do it. Fortunately, the physical demand is there, and I don't see it lessening, that's for sure.
Yeah, there's plenty of silver available as long as you're okay with moving a Post-it note around.
Yeah, or hey, what are you talking about? There's a silver shortage. I can go on APMEX or go on Silver Dr. Bullion. I can get a tube of maples. What are you talking about? That's not what we're talking about. We're talking about
right.
2 million ounces in size delivered to a vault in Hong Kong. Can you do that for me? It's a little different story. That's actually the basis of my idea. You mentioned earlier about this explosive summer and into the fall. And one, it jumps forward, typically start off of a period like we've had, a base with sentiment down and everything else. And then so you get a really strong move that catches everybody by surprise. And then everybody sits there, by everybody, I'm meaning the traders, even the stackers, and they think, well, I'm not going to buy now. Silver's all the way to 33 already. Surely it'll pull back, and so I'll wait. And then it goes to 36 and 37. Well, and now, it's always peaked at 36, so I'll hold. And then it goes to 39 or 40. And now all of a sudden you've already missed 50% of the move. And so that's the challenge of anytime you're trading anything from, paper stocks to metal. Nonetheless, the banks, the bullion banks, particularly JP Morgan, they know what they're up against. They knew it 18 months ago. They knew it 14 months ago when we almost had a signal failure on the COMEX in April of last year. They have engineered the last 14 months as an attempt to extricate themselves from this massive paper short position because they know, they can't not know. They know what they're up against from a physical standpoint, and they don't want to be the ones left holding the bag. And so as long as that physical demand continues, and we certainly don't see it abating, they're going to move out of this short position. And then once that's changed, once the banks get close to flat or net long, who else is left to sell? So it's that basis that'll drive silver higher. The physical demand will cause the banks to eventually give up that game just for their own well-being, and we'll roll from, at least that's, fingers crossed, that's what I'm looking for.
Right. Well, why don't we talk about the manipulation for a little while here? This isn't CNBC, so we're allowed to discuss it. When I spoke with Eric Sprott in early June, he made the point that the silver cartels had appeared to have changed their MO from rating the metals on the jobs report release to when Bernanke makes public statements or the Fed releases a statement. And once again, we saw that happen a couple weeks back with the June FOMC statement and Bernanke's speech. And I noticed you put up a portion of Andrew Maguire's weekly metals update over the weekend, and I kind of like to touch on that for a moment because Andy clearly explained in detail the 515 metric ton paper gold contract dump that happened just prior to the June FOMC statement that day. Because I think a lot of people have problems realizing that they go back and they look at the CME or the COMEX reports the next day, and the open interest really doesn't show any massive dumping. But Andy kind of explained it by saying that he said almost all these contracts were subsequently covered by the bullion bank into the day's pit close, thereby not showing up in the closing open interest numbers. This is a standard MO. So basically, to clarify for our listeners, essentially the cartel's MO during these raids is just to dump an astronomical amount of paper metal on the market indiscriminately. That causes the price to start heading basically in a waterfall down. That triggers all the speculator stop losses. And now as the speculative longs stops are triggered and they liquidate their positions, the bullion banks are sitting there, take the opportunity and covering their new shorts. And basically it prevents the whole episode from appearing on the day's open interest report because they've basically covered their tracks or covered all those positions into the close. Can we hear your thoughts on the process?
Yeah, that's a pretty good summation. They can look at it and say, okay, we know where we are versus, say, moving averages, or where we are versus what could be support lines. And so if you can come in and dump, let's just say for round number sake, 10,000 contracts, that gets the ball rolling. That then trips some sell stops, which is further selling. It starts the momentum chasing the HFT machines, the algos, they start selling. So there's this initial wad of, say, 10,000 contracts. Then that generates its own momentum to the downside. So now let's say we're $20 lower, when now the selling is all organic. It's the HFTs, it's the the other specs, whatever, that are selling. Well, again, now as they are now selling, who's on the other side? Who's buying? Because you've got to be a buyer for every seller. And so the ones that are buying now, as we're now $20 lower, is the gold cartel member, JP Morgan or Deutsche Bank or whomever that set it off in the first place. So at the end of the day, they've covered, they day traded themselves. They started a naked short and then they covered it down here at this lower price, so that they don't show a massive increase in their own position, but they effectively lowered the price. And people say that, I get people come up on my side and they'll say, "Oh, there's a $20 spike to the upside. Is that manipulation too?" Actually, these days it is, because they're doing the exact same thing on the opposite side. They know where now that there's so many specs that are short, they can gun them. It's just exact same process in reverse. And so that's all part of what we deal with when we trade paper metal. You had an excellent summation. But back on Andy McGuire's point, I think what he was talking about that day, and in that summary that he gave, and why the 515 is valid. What I think initially set him off to make these points was that he knew in London there was no physical metal to sell.